What's going on, guys? Welcome into today's show. We've got Randy Smith of Impact Equity, who's going to break down his fund of fund models. Being that so many people struggle with raising capital and finding a way to eliminate the concern around how you're going to get all the money necessary to get your real estate investments across the finish line. This is going to be a very impactful episode that talks about, one, his experience as a limited partner in 25 different deals, all of the do's and don'ts, the things that you should be doing due diligence on, not only on the deal level, but on the person that you're investing with, some of the red flags, his checklist. We talk about the different asset classes and strategies that his fund invests in. And ultimately, what some of the big mistakes are that he sees people who are trying to raise capital for their deals doing, and what the ones who are doing it successfully are doing. So an overall great episode for anybody that is investing in real estate, that's looking to raise money and do it strategically through partnerships, through funds, through syndications. Some great wisdom and insights from Mr. Randy Smith. So without further ado, let's dive into today's episode. Well, I'm excited to welcome to the show, Mr. Randy Smith. How are we doing, brother?
I am doing well. Thank you.
Well, I'm excited to dive into the topic that we're going to be spending some time on today because, capital is always, I would say, a mental hurdle and roadblock for many people in commercial real estate or just real estate investing in general. But when you really start to understand how financing works, how raising capital works, and you realize how abundant it actually is and how many different ways you can kind of pull it all together to still get your goals accomplished, it gets really fun and exciting. So you being somebody that's an expert in that space, I know we'll be diving into a lot of different things, fund-to-fund model, different strategies that you've used. That being said, I want to just kind of explore real fast a little bit about your career before real estate investing.
Sure.
You had a long career in corporate America before diving into real estate. What was that aha moment for you that made you go, corporate America, it's time to, close that chapter and take the leap going all in on real estate investing?
Yeah, great question. I think, for me, there was this point probably somewhere in between my two big career stints. I spent 10 years with two different organizations, and I got laid off actually from both organizations. So at the end of my career with Fortune 200 company number one that I dealt with, I had been playing this game where I was just pouring money into my 401k, really wasn't saving any money else at all. And when I got laid off that first time, I ended up getting a severance package, but it was a really scary time for my wife and I. Like I think we had 5 months. I was applying for anything and everything I could. It was kind of like a nice little vacation, but with each month that went by that I didn't get a job, I started getting more and more desperate. And it just planted in me this fear that, if I didn't have some other channel, some other income, I could potentially be in this position, even if I do go find another job at some point. And, fortunately, I ended up landing in this job, where I would spend the next almost 11 years. It was actually the best decade of my career. I made a ton of money. But about halfway through that, I started having flashbacks because any corporate America job, if you're there long enough, they have layoffs, they have reorgs, they have all of these things. And I just started thinking, like, I've got to do something different because the 401k, while it was growing, I did the calcs and it was clear I was going to have to work much longer than what I wanted to work. And I made the decision to start investing in real estate. And that was really kind of what opened my eyes to this whole other arena that, guys like you know so much about, and most of the folks probably listening. But it was this aha moment, like, I need to do something different. Otherwise, I'm going to be in the same position just 10 or 15 years later.
Yeah. I talk to so many high income earners, W-2 folks that are such talented people and their skill sets. Once you really kind of peel back the layers of the onion on who they are and what their skills are, man, you would kill it in real estate investing. You just don't either know it yet, or there's something that, is the fear. Usually it's something up in, between the 2 years versus it actually being a physical thing that is holding them back from taking that leap. So what did your first real estate investment look like? Were you still in your career and kind of doing that investing along the way while you still had the income and somewhat of the safety net, or did you
Yep.
cut cord and pull the rip cord and jump out of the plane?
Yeah, no, I was like 90% of the people that get into real estate investing. I thought I could buy single families and HGTV it and make all kinds of money and then just float off into the happy destiny there. But I ended up buying some turnkey single family rentals out of state. I'm located here in Phoenix, and turnkey in Phoenix just didn't make sense.
Yeah.
It came nowhere near hitting that 1% rule that I learned about early on. But we were able to hit it in Kansas City. I just made a really big mistake and chose a bad operator when I bought those first turnkey deals. And yeah, had kind of a bad experience there. So I decided I wanted to be more involved with the renovation process. It started doing the burst strategy in Atlanta. And the burst strategy was great. We created quite a bit of capital. We bought a handful of properties, and I really kind of enjoyed that process. But once again, it was this process where you buy a house, maybe you scrape together 25 or 50 grand to buy a house, and then you're making a couple $100s a month. And I started doing the math on that. Like, I'd have to buy 100 houses and either have 100 houses that were cash flowing or 50 that were paid off. And the thought of doing that process to that degree just was overwhelming. So that's when I found the passive investing space and kind of went all in that space.
Cool. So I know we're going to kind of dive into that for a second. I just wanted to rewind real fast because I think there's always some wisdom in, those early real estate learning lessons when you're like, I think everybody, I know I did when I was like, yeah, I'm going to be a real estate investor and I'm going to be flying on a private jet in no time. And, I'm going to have cash falling out of my ears. Like, what do you mean it's going to be hard and challenging? Come on, man.
Right.
And everybody kind of has that, that kind of scrape your knee type of story at some point early on in their real estate journey. What would you have done differently going back, to that early season where you decided to go the turnkey route? Because I've heard a variety of different kind of war stories from people that went the turnkey route and, thought it was going to be completely passive. They thought somebody had all of the kind of verticals in the business model taken care of and were really sound and strong in those areas. And it ultimately ended up being a time suck, a money suck, sometimes money lost. What did you learn in that process that maybe that early investor that's like, hey, I want to get into real estate, this model might sound good, or you said even single family, right? That sounds like the easy, safe stepping stone. I know that's what was my path as well. What did you learn in that process, and what would you have done differently looking back?
Yeah, good question. I think it's funny you mentioned, did you have that knee scrape moment? And I'm looking back over the last 6 or 7 years, and I feel like I have a knee scrape moment about every other year.
I got one every day. It feels like
exactly. Yeah, and I am very much a jump out of the plane and build the parachute on the way down, ready, fire, aim guy. And I was the guy that was sitting on the sidelines, reading all the books, listening to the podcast, procrastinating, not wanting to jump in. And then the very first investment was just a guy that I heard on a podcast. It was a very large branded podcast that I assume that since this guy was on this very large, well reputable podcast, that he was a guy of high integrity. And I jumped in too quick and I didn't do the due diligence that I should have done. Ultimately, when it came down to buying the specific assets, he gave us the option of doing an inspection. And he said, you can either do your own inspection or, we do our own inspections and you can just review mine. So feel free to spend the $300 or $500 to get the inspection or not. And I trusted the guy. And when it was all over and done with, we ended up having, I don't know, like an $8,000 roof replacement at month 2. We had about a $4,000 plumbing repair at month 3. We had like a $4,000 issue with some grading, so it was just expense after expense after expense that we would have caught had we done our own inspections and then trusted that. But I didn't. I trusted the guy and I didn't verify. And ultimately, fortunately, it was in a market that was exploding. And real estate is very, very forgiving. So we still made some money on those, but it never cash flowed. We were always pulling out of our pocket. But fortunately, by the time we sold, we still ended up making a few bucks on those early investments for sure.
So low cash flow or no cash flow, but you were fortunate enough in a rising market, like you said, at least be able to cash in on some equity and, see something. I always tell people too, oftentimes when you go through a lot of those painful deals or some of those learning lessons, if you can go through those things and come out not losing money, that is a win. That's a win in itself. Maybe you didn't hit your 20% IRR, your 10% cash on cash that you were hoping for, but the fact that you got the learning lessons, you know what to do, what not to do, and you just kind of build this confidence, right, going forward that you can parlay that experience into something that hopefully you can hit those ROI return metrics that you're aiming for. That's a win.
Yeah. And maybe the return that I got on those initial deals was that I did more deals. If that's the only return that I got on that, then that was fantastic. So I could have still been sitting in W-2 with just money sitting in the bank account too.
Yeah. So you found, like you said, the passive income model. How do you define the passive income model per your definition or perspective?
Yeah, another good question, because I think a lot of people think single family is passive as well, which it absolutely is not, or at least it was not my experience anyways. So a true passive investor today, I consider that or define that just somebody who's a limited partner investor, where they're going out and they're finding operators that hopefully have good track records, and we trust our dollars to those operators as a limited partner. So that was the path that I pursued after the initial one in the Burst strategy, and eventually found passive investing.
Now you've invested in as a limited partner, I think you said 25 plus deals, maybe that's even higher now. What do you look for in an operator before writing a check and, entrusting somebody to be a steward of your capital?
Yeah, good. Then that is the question to be asking if you're a passive investor, is how do you vet and how do you find those operators? I will share that it's been an evolution. Early on, again, my very first passive investment was another podcast host. It wasn't a guest this time. It was actually a podcast host, somebody who had a very large brand that I spent probably hundreds of hours listening to as I was driving around town, going from appointment to appointment. But that's evolved quite a bit. I now have like 100-point due diligence process that I go through, vetting. Usually track record is a big piece of it. Something that I just started doing in the last 6 to 9 months is I really want to dig in and understand what's going on with their current portfolio. Obviously, past performance can't ever guarantee future, but if they've made it through the last 3 to 5 years and their portfolio is still performing well, then odds are they're going to do okay when they're buying assets today in what I would say a much more forgiving marketplace today. So I spent a lot of time on that, and then ultimately you're investing in people. So if you can vet those people, and you're betting on the right jockeys, then odds are they're gonna be good stewards of your dollars.
What are some of the red flags that when you're kind of doing your due diligence and you're digging in, obviously you've got a pretty big, extensive checklist on, the things that you want to see be there. What are some of the things that if you see them are complete deal killers for you?
Yeah, so deal killers, it used to be if they had lost capital or if they'd done investor or if they'd done capital calls. What I'm finding is people that are in the space for any amount of time, it is likely that they've done capital calls, and capital calls aren't always a bad thing if they're actually using that dollar to actually fix the problem or create a permanent solution. So today, when I see things like underwriting assumptions that just don't make sense, then that'll get my attention real quickly. Fee structures. If you start seeing people charging more fees than what are the norm, you got to start asking the question of like, why does this group have to charge 4 or 5% acquisition fee when 80% of the guys are charging 2%?
Right.
Crazy deal structures. Like, you don't have to get complicated with deal structures. Like there is, if it's anything different than a 7-pref 70/30, like we need to figure out why you go away from that for some reason. So you start seeing crazy deal structures, then that's usually a big red flag for me.
Of all of the deals you've invested in as a limited partner, is there any common thread or theme of the ones that have gone well and either hit, well, here, how about this? How many of the deals that you've invested in have hit or outperformed the metrics that were displayed in the PPM or the offering memorandum?
Yeah. So of the 25 that I have done, I've only had one deal go full cycle.
Okay.
And that one blew the numbers out of the water. We got like a 1.8x equity multiple in 14 months. So it was during an explosive market that everybody got excited about and deployed a bunch of capital into. So when I look at the portfolio today, about half of the 25 have either paused distributions or decreased them dramatically.
Okay.
So
And why is that?
A lot of operators, the main reason is people were using floating rate debt with rate caps on it. And as we all know, interest rates went through the roof. And if they had to sell or if they're having to go back and get new debt, then those deals are not going to cash flow anymore.
Yep.
So that is the single largest decision mistake that I made with my passive investing was investing in those type of deals. Now, many will argue that if you were placing capital during 21 and 22, the only people that were doing deals with floating rate debt, with fixed rate caps. So if you deploy capital in 21 and 22, you probably have deals that are struggling. And I'm certainly, I won't say I'm a victim to that, but I am certainly experiencing that.
Yeah. I would say a lot of people are in that same boat, right? Is like you kind of sometimes we were having this conversation in a mastermind in my commercial mastermind group a couple of weeks back of, limited partners, some people experiencing exactly what you're talking about, right? And obviously we know that the market goes in cycles and, post-COVID era was a kind of whole other anomaly that, you could look back in the history books and see some clues, but there were some new variables in this equation that were kind of hard to account for, right? And we were talking about this overall idea of like, there's good deals and bad operators. There's bad deals and good operators. There's kind of all of these different, and so it's one of those things sometimes where you could be a good operator and just have some things happen to you that are somewhat out of your control. But that's really, in my opinion, a small sliver of the people who are maybe experiencing some headwinds that are maybe pausing distributions or trying to do capital calls to make sure that they're, still protecting the investments and their investors. And then there's a big group of people that got in during that window of time that, probably had no business raising money and doing some of the deals that they were doing because they weren't experienced operators. What would you say have been the best performing deals? Is it an asset class? Is it a strategy? Is it a market? Is it a blend of all of those? What's your experience been?
Yeah, I think the main lesson for me is debt is probably the single biggest risk that you have on any specific deal. So I'm a fixed rate guy. I like 5 and 7 year fixed rate debt. I think that gives you enough time to make it through the downturns or the down cycles to get through. 3 years, even there's a lot of groups today that say that now's the best time to be buying assets, and 3 year fixed rate or 3 rate floating with the fixed rate cap is good enough. And I'm gun shy. I think we still need 5 and 7 year debt because who knows what's going to happen through this administration and some of the challenges that we're seeing today. So I think fixed rate debt is the number one deal. It's hard to say. I think you can make money in any asset class, in any market, at any time. There are niches where you can make money in real estate, and it's just finding the right operators that are making the right decisions in those places. So there are people that did very, very well during the time when all of these other deals were struggling. It really just comes down to the operator and their expertise. So, and then also, the integrity of the operator that you're working with. If you've got folks that are making the hard decisions and doing the right thing for the investment, even though it might not feel comfortable today for the investors, that's the type of operator that I want to partner with. That makes the hard decision when it's not the easiest thing to do. So
you've invested in many deals yourself. Talk about your business and your fund to fund model and how you ventured into that space.
Yeah. So when I got that call again in corporate America that I was getting laid off again, um, and it was the oddest thing. I was actually at the top of my game and had just won President's Awards and was coming out of some of my highest income earning years of my life. Um, it showed me one more time that in corporate America, there's really no job security. If they're going to go a different direction, they're going a different direction.
Yeah.
Fortunately, at that point, I had invested pretty heavily in all these single families and passive, then I was able to cover a large portion of my household expenses when I left my W 2. Um, so at the time, I was pretty vocal with what I was doing while I was in my W 2. And a lot of people started raising their hand and asking how to get involved, how to invest in the same types of deals that I was investing in. So when I stepped away from corporate America, I talked to pretty much everybody in my network, and all of the mentors around me, all of the people that I trusted, and there was this clear need for capital. And one of the operators that I had raised, or had actually invested pretty heavily in, he presented this opportunity to me where I could actually bring investor capital to his deals through this fund to fund model, which was kind of emerging through some of the challenges that operators were having with co-GP situations and scenarios. So I ended up sharing a deal with my network and raised almost $1 million in a couple of weeks and figured out pretty quickly that there was an appetite for this type of offering amongst my peers, my colleagues, my coworkers, and that's how Impact Equity was born. So I doubled down on that, and fast forward a couple of years, I've done 18 projects, and we brought about 13 million to different deals. And fortunately, I came into the space as the market was turning and it was getting harder to raise capital and harder to find assets that work. So the portfolio that I've raised on is actually doing extremely well comparative to the acquisition, compared to my own portfolio, unfortunately. Um, but it's actually doing very well. And the challenge today is now just trying to find deals, not so much trying to find investor capital, it's trying to find deals to put in front of my investors.
Yeah.
So
So for those that don't understand what a fund to fund model is, how would you explain that?
yeah, so a fund of fund is just simply when I find a deal that I want to bring capital to, I will have my SEC attorney create an entity and create legal docs, and my investors then will actually invest into my fund. And the reason, the benefit, the main benefit is that generally when I'm bringing a larger check size to the people that I partner with, they're going to give me better economics and better returns than they would give to a 25 or 50 or $100,000 investor. So because of that, I can generally give my investors the same or better returns as if they were going to go directly to the operator. So the operator benefits because they get to leverage my network and they don't have to give a portion of their GDP away because we're just coming into their deal as a limited partner. So it solves the SEC challenges. It solves the operators' need to bring additional capital into their deals. And it creates an opportunity for me to monetize my network and to continue to train and educate and bring value to my audience through my offerings.
Now, with deals being as abundant as they were before the Fed, kind of pivoted and started raking heights, or hiking rates, there was an abundant of capital flying around, right? And also an abundant of deals to park that capital in. And then obviously when things kind of tightened up, capital started to get a little bit more patient. They started to, be a little bit more disciplined and diligent with what deals they were putting in. And then deals obviously tightened up and economics, started to be a little bit more challenging to hit some of the returns that people were getting excited about, a couple years prior. How did
Yeah.
you continue to find success in raising capital with some of the, economic challenges and headwinds that have been out there the last couple years?
Yeah, so I think, gosh, that's a hard question, right? So initially, there were some shops that had some groups that I worked with that did a ton of deal flow. And it is possible they were buying, paying too much for these assets. They were doing rate buy downs. They were doing a lot of creative things to make the economics work and create the returns on the underwriting models that investors were looking for. Um, Probably a big piece of my journey, my education, and my up leveling of my sophistication in this space was actually joining GoBundance and getting access to the passive investing community within GoBundance, as well as access to a lot of the operators in GoBundance as well. That helped me really start to refine my process and be able to identify what a good deal looks like and what maybe not so good the deal looks like. So there's really been an evolution there where I've moved away from some of the groups that I used to raise capital for. And now I'm going to some of those tried and true operators that I found within our community. So it's really been advantageous to myself and to my investors to get access to these that they might not have had access to otherwise.
Is there anything specific that you feel like you do that builds the trust and the credibility that gets somebody to stroke $100 or $200 or $300,000 check with you into your funds? Or what would you say capital raisers should be thinking about and focusing on mastering in order to build that authority and brand as a capital raiser to get people to stroke checks with you?
Yeah, so I think first and foremost, people that are raising capital need to invest in deals. They need to be able to walk their investors through the process and build credibility from them, just to show that they've done what they're asking these people to do. There's a ton of people in the space that raise capital that don't even put capital into these deals. So first and foremost, you've got to invest in deals. I think at the end of the day, people buy, and you hear this all the time, but people buy and they invest from people they know, like, and trust. And the way that you build that know, like, and trust, there's a saying like the 7-11-4 methodology, where you need to have 11 interactions across 7 different, what is it? Oh, 4 hours, 7 different venues and 11 different interactions, because you need to be in front of these people and you just need to build a relationship like anything. If you want to have a relationship with your kids, you got to spend time with your kids. You want to have a relationship with your wife, you got to spend time with your wife. So it's the same thing with investors. If you can get on the phone, get face to face and spend time with these people, and then just be a human being and be transparent and connect with people, that's who people are going to invest with. Like the people that invest in my deals, quite often they're not looking at every single line item, reading every page of the
Right.
OEMs. They're not digging into the underwriting. They know that Randy's presenting a deal to them and they trust Randy. So you got to build that trust, and that takes time, and it takes a lot of work, and it takes energy. But there's systems and tools that you can put in place to do that as well. And that's a lot what I focus on. I going back to my sales years, like I've got a CRM that I use actively. I've used newsletters, so I'm in front of my people constantly. I've got a podcast where people can come spend 45 minutes to an hour with me once a week, and they do. I can tell you the first time I went to a conference and somebody ran over to me like they thought I was somebody famous, I was like, I'm a nobody. Like, I just happen to have a podcast, but you happen to be listening to it, but they are building a relationship with me by listening to my podcast. So
Yeah.
if people can do those things and then put the right deals in front of their investors, I think they're going to do very well.
I know you alluded to it a little bit, but for maybe somebody that is, I know when I was first starting out, I'm going, okay, I need to raise money. Like, who are these people that have the money? That where should I find them? What should I say to them? For that newer capital raiser, how do you help them kind of break the ice or, get some traction in the early stages?
Yeah, so I am a big LinkedIn user. That's initially how I raised my very first deal. But I've been using LinkedIn for years, like for 15 years, probably in my sales career. So I had 4,000 or 5,000 connections that I was using it as a tool for prospecting, for networking within, American Express and Waste Management for 20 years.
Yeah.
So these were actually people that knew me, that I had relationships with. So when they got a message from me that said, "Hey, I'm not sure if you're aware or not, but I'm now in the commercial real estate space. Let me know if you want to chat. Like, they picked up the phone and got on a phone call with me because of that relationship. So people need to find, and let me back up a little bit. So I remember when I left, like I had this idea that, I knew what I was doing was fantastic and it was super excited and I loved what I was doing. And I just thought, like, if there was some way that I could share with everybody in my network what I'm doing, I'm convinced that they're going to come partner with me because I'm a good guy. I've been a performer. I've always done well in everything that I did.
Right.
And most of my network knows that as well. So finding a way to get my message in front of them was what was critical. So when I'm working with coaching clients in the space now, we take a look at like, where are their social assets that they have today, relationship assets that they have today, and how do we get in front of them? And it might be LinkedIn, it might be social media, it might be just picking up your phone and making a gazillion phone calls to everybody in your network. I don't know. I'm not sure what it is. They generally know where they are.
Right.
But if you can get your message in front of them, into people that already know, like, and trust you, then that's how you're going to get started.
Yeah.
After you get through a couple of deals doing that, you got to figure out ways to scale and do top of funnel and all those other types of strategies. But first and foremost, let's cast the net to our existing network and try to bring those dollars in.
The people that I've seen do the best with it are the ones who are playing the long game, who are, really looking at it from a place of service and value and just consistently delivering it over and over. It's kind of, I look at it like a bank account, it's like, I'm just going to keep making deposits and deposits and deposits and see my account grow and grow and grow. And eventually when it is time to, ask for a withdrawal, I'll have built up that goodwill, that trust, that currency for people to want to go, yeah, cool, take my money. Right. And it's wild how many times I've raised on deals that, like to your point, they're like, yeah, take it. Like, I don't have any questions for you. I'm trusting in you. And that's where obviously there's a strong sense of integrity and ethics and, doing the right thing and treating the money like it's yours, that if you want to have a long career in it, you have to be so disciplined and diligent about those things. Cause, there's that saying of, it takes 30 years to build a reputation and, one decision in a moment to completely destroy it. And capital raising is one of those areas that it can unravel pretty quickly for people.
Absolutely. One deal goes sideways with your very closest friends and family, and things are going to look very different.
Yes.
So, yeah.
How are you communicating with your investors? I have found that, hey, things, go good, they go bad, they're indifferent. The communication is such an important thing for people that are entrusting you with their investment dollars. How do you, feel the kind of the gold standard of the way people should be communicating with people they've got capital from? What does that look like from your perspective?
Yeah, good question. So it's sharing bad news with investors is uncomfortable.
Totally.
And bad news needs to travel much faster than good news. Unfortunately, and even though it's
good point, right?
It's very uncomfortable to make those calls. I have one deal that we've paused distributions on, and I made a phone call to every investor. Those were not fun calls. I didn't want to make those calls, but most of those calls ended very well, where people were like, well, thank you so much, Randy, for calling and telling me what's actually going on. And hear what the plan is to get this thing back on track. So I have a process where, of course, I do monthly and quarterly updates on all of my deals. Some are monthly, some are quarterly. But I also have like a texting cadence and I have a phone cadence where I reach out and pick up the phone and have conversations with my investors. I think, like, if you're not sharing information, people will go to negativity. So you're better to get ahead of it. Even if you have to share difficult news, it's better to reach out and do that versus letting them reach out to you to ask for it. So yeah, I think constant communication is a commitment you have to make if you're going to be in this space. And if you don't, if you're not in this for the long game, you're not here for 10 plus years, don't get into this business because these are going to be long games anyways. And there's going to be good conversations and we're going to get to celebrate, but we're also going to stub our toes and scratch our knees every once in a while. And we just got to keep showing up and act with integrity in those situations.
How do you think capital raising, passive investing, how do you think that's going to evolve over the next 3 to 5 years? Do you see any big changes or differences with maybe how AI is, changing the space or just the economy as a whole? Like, what's your perspective on kind of the near future?
Yeah, I think so. In the long run, I think real estate values go up and to the right over any considerable amount of time. Real estate values will go up. I think I specifically focus in multi-tenant, so multifamily. I will likely get into mobile home, potentially self-storage at some point. Um, I think as a whole, the fundamentals, we've got a housing crisis that will continue to drive demand in this space. AI is going to change every aspect of every business in the world. If you're not on board with AI, like just step out of line and let others jump in there because you're going to get passed up if you're not using AI. And I absolutely love AI. I am in Chat GPT 50 times a day. And I use it with all of my clients. I use it for investor, like I use it constantly. As far as capital raising is concerned, I think, the fund to fund model has emerged over the last, call it 5 years or so. It's getting more and more prevalent. The way I see it going is kind of this mega fund. I'd call it a mega fund strategy where you bring a handful of capital raisers under one entity. So it's the same type of model, but you might have four people that essentially are co-GPs on a fund. And if those folks can bring $1.5 million a piece, so now they're bringing $4 to $6 million a deal, that starts to garner even better economics for the fund, for the fund managers, and for the investors. And it solves this huge need where there's these small to medium sized operators where they have they're great at finding deals, they're great at operating deals, but they just cannot stand raising capital, and they're looking for a turnkey solution for raising capital. I think Mega Fund will be a solution for that. But the challenge is that mega fund managers have a really in-depth due diligence process that some of those smaller guys aren't going to be able to get through. So finding the blend there, which is honestly the challenge I'm having today is the people that want me to raise money for them have a hard time getting them through my due diligence. And that's why I've only done, actually, I haven't even done a deal this year. Technically, I closed out a deal this year. Whereas year one, I did eight deals, so there's going to be some evolution there. I think there's opportunity for operators and for investors and fund managers. And we're going to see more and more of that.
Yep. Now, this kind of segues into my last question, because I always love to see the vision behind people that are doing great things. What is the vision, the mission behind Impact Equity, and what legacy are you working towards building with it?
Yeah, so when I launched Impact Equity, my goal was to make alternative passive investing available to the masses. And I wanted to be able to provide diversification across asset classes, operators, geographies, business plan. And what I've added into that sense is like over market cycles. So I want to be able to be a one-stop shop for the high-income W-2 earner to place capital consistently over time and get diversification in their deals. Now, the name of the company is Impact Equity. So we're trying to do that and have impact on our communities as well. And last year, we had the opportunity to partner with a group called Playworks, which is just an amazing nonprofit organization that brings kind of social skills to the playground and teaches kind of underprivileged kids how to interact and communicate and essentially play nice and grow up to be good adults, essentially. And we're able to bring a nice check to them through that. And we're trying to do things like that to bring the impact to our community because, it's great to give great returns, but it's even better to give great returns and then also be helping the community in some way as well. So my goal is to continue to put these types of deals in front of my investors. Obviously, I'm vetting deals for my own dollars as well, but I just want my community and my network to be able to benefit from that as well.
So if somebody's listening and they are an investor, that's looking to, be an LP and place capital, or maybe a GP that's a sponsor and has, some of the track record that you're looking for, and they want to connect with you. They want to learn more about you or Impact Equity, your podcast, your coaching program. Where's the best place for them to do that?
Yeah, best place to find me on the capital raising space is impactequity.net. Of course, we've got our podcast, which is called The Gentle Art of Crushing It. We've got 250 episodes out there. Come and listen.
Nice.
And then if you're interested in learning how to do this, how to raise capital like this, my coaching and consulting is under raisecapitalcoaching.com.
Well, guys, be sure to check out all of the links down below in the show notes on Randy's episode. Mr. Smith, always great connecting with you, brother. Thanks for coming on.
Thanks so much.
Well, that wraps up today's episode. Thank you so much for tuning in. As always, you guys know this show would not be what it is without you, the amazing listener, the support, sharing this out with other people who can gain value from it, taking 60 seconds to leave a review. If you haven't done so already, those things mean the world to us and ultimately help us spread this message out to as many people as we possibly can to help them on their wealth building journey. If you have any particular links or resources that you're trying to track down that were mentioned in this interview, be sure to check out this episode at millionairemindcast.com, where you can find access to all that information. And of course, if you haven't checked out the Wise Investor Vault yet, be sure to head over to wiseinvestorvault.com to check out all the tools, all the resources, the checklists, the spreadsheets, the trackers, all kinds of amazing things that can help you on your wealth building journey at the wiseinvestorvault.com. If you haven't connected with me on social media yet, I'm consistently putting out more content, stories, value to help you on your wealth building journey. And one of the best and most exciting things for me on a weekly basis is getting to connect with you guys. Getting your DMs, hearing what things impacted you, what you need help with is a big way that we continue to drive the content for this show. So if we're not connected and following each other on Instagram, on social media at Official Matty A, give me a like and a follow. Would love to connect with you there. And of course, don't forget to get on my deals list. If you're an accredited investor, you want to look at more deal flow. You want to see what deals I have access to, what deals I'm raising capital for. This is an exclusive list that I only put out to my accredited investor list, my Millionaire Mindcast family. So text the word deals to 844-447-1555. And with that being said, thank you again so much for supporting the show. Until next week's episode, keep investing in yourself, in your wealth on your march to $1 million and beyond. Cheers.